Dear investors, given its topicality, this podcast looks at Brexit implications for both sterling and the FTSE 100 index. However, its broader scope also encompasses the evaporation of business cycles and the thorny issue of equity valuations. The topic of Brexit is seldom far from the headlines, but it shot right back to the forefront in mid-October with the news that EU officials are willing to let talks drag on way beyond the looming deadline. The clear implication is that they are trying to force a less UK-friendly outcome. However, should both sides find some middle ground that ultimately leads to a workable deal, investors will naturally question whether sterling and the FTSE 100 index offer a source of value given their prolonged underperformance. The first point to make is that whilst the FTSE has been hammered in relative terms, the same cannot be said of sterling, which has remained surprisingly buoyant. A no deal is likely to see both come under further pressure. In a normal scenario, further weakness in sterling should actually make UK exports more attractive. But continental Europe is the UK's major export destination, and a hard Brexit would bring an end to the favourable trading environment that Britain currently enjoys. Consequently, the correlation between sterling and the FTSE, which has traditionally been negative because of the export argument, could actually turn positive, with both slumping further in the aftermath of a hard Brexit. The only seemingly weak point in favour of the consensus position that the FTSE offers good relative value is that any sort of conclusion to the long-enduring Brexit negotiations would finally take uncertainty off the table. Nevertheless, from a composition perspective, it is hard to get overexcited by the prospects of the FTSE even in the best-case Brexit scenario. A good deal will do nothing to address the FTSE sector weightings, which are dominated by financials. Banks will be dealt a more difficult set of cards in a negative rate environment. And furthermore, the FTSE sector weighting is also dominated by mining companies. As such, my view is that investors should give UK assets a wide berth for the time being, deal or no deal, as relative underperformance appears set to continue. What happened to the business cycle? Back in 2014, we lamented the disappearance of the credit cycle. Now it appears time to bid adieu to the entire business cycle, as central banks increasingly take on the responsibility of steering the economy away from deflation, regardless of opportunity and financial costs. This paradigm appears set to continue well into the future in the absence of an inflationary surge or much-needed return to growth. One of the unintended consequences of extreme or unconventional monetary policy is to drive investors into riskier assets. The performance of key equity indices since their trough in March 2009 is indicative of the central bank's success in this respect. However, the inevitable outcome of many years of this monetary policy is that the tailwinds have driven equities to valuation levels that appear very expensive in relation to historical norms. Ultra-low interest rates provide ample scope for price-earnings ratios to climb to unprecedented levels without implying that the market is overvalued. Let me give you an example. For example, assume that the long-term PE average ratio is 14 and the long-term interest rate average is approximately 6%. The reciprocal of the PE ratio is the earnings yield, so a ratio of 14 provides a yield of 7%, moderately above the long-term interest rate, which is precisely where one would expect it to be. However, if US Treasury yields are 0% and the equity risk premium is deemed to be 3%, the PE ratio could be around 33, equating to an earnings yield just north of 3%. If we furthermore assume that growth stocks can expand at a rate of 2% per annum in perpetuity, the earnings yield is effectively on a continual downward slope. Those stocks could easily trade on a PE of 50 or more. Are investors comfortable with those valuations? As long as interest rates are near zero or negative, I would say yes, but it would store up huge problems for the stock market when monetary policy normalizes. Also, that eventuality could be much further down the road than most appreciate. In the meantime, deficit financing will remain high and effectively channel capital flows towards equities. In this year, we have seen a massive acceleration of existing post-crisis trends. Investors are increasingly happy to shun old-world brick-and-mortar stocks such as automotive, airlines and banking in order to go for businesses that are aligned to automation, digitalization and online lifestyle themes. This is quite rational in an area in which more of us are working from home and spending increasing amounts of leisure time indoors due to coronavirus risks. However, it is difficult to escape the conclusion that too much money is flowing into too few stocks, such as the FANGs, Facebook, Amazon, Apple, Netflix and Alphabet. And this is fragmenting equity markets. Low-cost ETFs are fanning these particular flames, and many are also short volatility as a cheap bet on the continuance of the current status quo. However, it is never prudent to rule out mean reversion in the longer term. The huge distortions in individual stock valuations will have to be ironed out one day, and volatility will surely rise to more realistic levels at some point. The hard question is that of the timing of a potentially seismic market event. The current market rebound looks vulnerable to my mind and dependent on stimulus programs. A recovery of the world economy will be near to impossible as long as the cure against this pandemic is missing. Take care and all the best. Oliver.